Okay, so let's move on with what we were discussing in the first session. So I think I was making a point about summarizing the payment of expense and receipt of income. So you can appreciate that anytime you pay expense, it decreases capital and also decreases asset. In terms of the T account, you open the expense account, debit it, and open cash or bank account and credit it. The opposite is for income. So for income, it increases capital and also increases asset. If you're opening the T account, you open your cash account or bank account, depending on whether it is cash or check, and you debit it, and you also open the income account and pass the corresponding credit entry. Okay, so I think I'll quickly do that of return inwards and return outwards for us, but I'll be seeking your opinion on that since we have already. So let me look at return inwards first, which is also known as sales returns. These are objective test questions, so pay attention. You could have sales returns is also known as A, return inwards, B, return outwards, C, discount allowed whatsoever. So pay attention to some of these things. Good. So return inwards, what did we say about return inwards? In terms of the increase and decrease, that's the effect. We said that return inwards means that your customers are returning goods to you, the business. So customers or debtors returning goods to the business. So there's going to be a decrease in assets, which is the debtors, right? But the debtor is returning goods to you into a cannot do business in. And there's also going to be an increase in asset stock. Okay, but that increment is as a result of return inwards. Now, in terms of the T account, this is what you do. You open two accounts, which are return inwards account. What do you do to that account? You debit it. And the corresponding entry goes into the debtors account. So if the debtor's name was given Kofi Ama or KK Limited, you write, you use the name of the debtor and you credit it. The opposite is for return outwards, right? Return outwards. So for return outwards, here this time it is the business returning goods to the suppliers or creditors. So we saw that it is going to lead to decrease in asset stock, which is in the form of return outwards. And there's also going to be a corresponding decrease in liability, which is the creditors balance will decrease. So in terms of your debit and credit account, you would open return outwards account, return outwards account. So return outwards, and you credit that account. So you credit that account, and the corresponding debit will be in the creditors account, which will be the debit. The last one is drawings, and I want to believe that you remember issues we discussed about drawings, that it is going to decrease capital and also decrease the particular item that was withdrawn. So if it is cash, cash will decrease. So asset cash will decrease, and drawings decrease capital. So anytime there is drawings, the first effect is that it decreases capital. Okay, and it also decreases the asset. Is it cash, is it bank, or is it stock? But in terms of the double entry, you open drawings account and debit it, and the credit will be in the cash, bank, or if it is stock, purchase account. Thank you very much. So let's pick the first illustration here. But before we move on to the illustration, please, so if you have questions, ask me. It is my prayer that we'll finish this question. If we don't finish, you'll continue with as an assignment for me, or you won't do it. Okay. I think I want us to take this short question. I had in mind a longer question, but let's take this one. Please ignore the requirement, show the effect, prepare the statement, prepare the balance sheet. And let's only focus on prepare the ledger account. So let me erase this. You are required to prepare the ledger account. So anytime you see this, prepare the ledger account, it means they want you to prepare the T account. Okay. So I'll need you to read. I don't like reading questions. So who would read it for me? I think the lady's voice sounds refreshing. So let's pick Prof. Alexia to read the illustration for us.
The following transactions relate to Mr. Youngson Limited for March 2008. First March, started a business with 1,000 Ghana cedis cash. Bought goods worth 250 Ghana cedis on credit from KK. Contracted a loan of 500 cedis and opened a bank account. Bought vehicle 125 cedis, paying by check. Cash purchases of 180 Ghana cedis. Paid Jackie 250 Ghana cedis cash. Withdrew 100 cedis cash for 800 cedis, for private use from the bank. Bought goods on credit from Ivan, 150 cedis.
Okay, so interestingly, this was a question that I gave you as assignment for you to show the effect, increase and decrease. So for now, let's prepare the ledger account, the T account. Now, one thing you have to take into consideration whenever you are asked to prepare the account is you can't have 2 or 3 or 2 or more account for the same item. So it means that if you go through the transaction and you see cash, you should only have one cash account. Regardless of cash is repeated in, let's say, first transaction, second transaction, and specifically here, you see started business with 1,000 cash, cash purchases, pay Jackie cash. So even though you are seeing 1, 2, 3, they should all be in the same one cash account. So you don't have to be repeating account. You just have to put all of them in one account, right? Good. So now let's pick the first one. I always advise my students, write the name of the business before you start the question. So this is my solution sheet, right? So I would indicate that this relates to, so in the books, normally we refer or we prefer you using the books of Mr. Youngson, right? Do that beautifully. You get a tick for that, a mark for that. Okay. I think I need to welcome somebody. Frank. Frank, you are welcome. I don't know if he can hear me. Okay, but let's move on. So in the books of Mr. Youngson, you do that, you get your first tick. Good. Now we go to the first transaction, which is started business with 1,000 cash. So based on the discussions we've had so far, if you see this, what comes to mind? This clearly shows us the owner is making an investment. And the investment came in the form of cash. Now, in order not to, jump the gun, let me seek opinion from you. So here, what do we do? Or what two accounts do we open? Yes, Prof. Richmond, what two accounts do we open? Okay, so capital account and cash account. That is very true. So I have my cash account here and my capital account here, right? Good. But you always have to pay attention to your currency. So the currency is cedi, so I have to change this currency to cedi. Now that we know the two accounts we have to open, which one would we debit and which one would we credit? Yes, I think Bishop will do that for us. Yes, Prof. Bishop. Who do we debit? Who do we credit? Okay, did I hear debit the cash? Yeah. Oh, Prof. Bishop, it is your network. Your network is not so smooth. But if you can hear me, that's fine. Okay, but I think I heard him saying that we should debit cash and credit capital. And that is the case. That is true. I think he wants to make a point too. Please, you can type in the chat if because your network is a bit scratchy. Okay, so anytime you see the owner making investment, we all saw that capital comes in and then the asset. In this case, the asset is the cash, right? So we open capital account, we credit it, and then we debit the cash. Okay. So on the debit side of capital account, remember to put in the date, and here the date is 1st March 2008. Under the details, you put the corresponding account. So we have just seen that you open cash account and capital account. So in the cash account, the detail will be capital. That's the corresponding account where you are going to have the corresponding entry. We put 1,000 there. And then in the capital account, 1st March 2008, cash as the detail, we put here, let me do my entry well. So 1st March 2008, cash 1,000. Okay, so that's for the first transaction. I have lost Prof. Alexia. I wish she could rejoin so that we move. Good. So first of all, I want to explain something. Started business with 1,000 cash. We all agreed that if the owner starts or makes investment, capital increase and then asset also increase. Here, the asset that increase was cash. And per the double entry principle, when an asset increase, we debit. That is why we are debiting the asset cash, because it is increasing. And we credit capital because capital is also increasing, right? Thank you very much. Let's look at the second transaction which occurred on the 5th. So on the 5th, bought goods worth 250 on credit from KK. Bought goods worth 250 on credit from KK. Yes, who is going to give me the two accounts, and if possible, add which account we would debit and which account we would credit. Yes, I think Sir Richmond is ready, but I won't call him this time. Prof. Frank, can you attempt this one for us?
Sir, I think we should debit the purchases account, then credit KK account.
Exactly. That's perfect. Thank you very much, Prof. Frank, the Egusi soup man and the Okay, so we are debiting purchases because anytime the business buy goods, okay, we refer to the purchase account, which acknowledges increase in stock, and stock is an asset. And if an asset is increasing, we debit it. So that is why we debit the purchases account. So 5th March 2008, we debit purchases, but the details would be, the details is going to be the KK, right? That's the supplier who gave us the goods, and we put the amount 250. I think my currency has not been put there on top of the amount column. So let me do that. Let me do this entry again. So let me put my currency here, which is cedi. If you use the wrong currency, the examiner or the marker can penalize you. So always use the right currency. Okay, so 5th March 2008. The details will be KK, which is the supplier who gave us the goods, the amount of 250. So we debit purchase and we credit the supplier, who is KK. Okay. So let me change the currency for KK2 as well. We credit KK on the 5th of March 2008. The narration will be purchases, which is the, so there we have it. Prof. Alexia, sorry for the network hiccups you are having, but welcome once again. Good. So for the second transaction, bought goods, and I've told you that anytime you see bought goods or bought something that the business is buying and selling, trading in, then that is purchases, right? But in terms of the effect, when you buy goods, stock increase, asset stock increase. So you have to debit, but you debit purchase account. Then the corresponding credit goes into, in this case, the creditor's account because we didn't pay. If we had paid money, which is cash or check, we would have credited cash or bank. But because we didn't pay, we have to credit the creditor. Good. The third one, contracted a loan of 500 and opened the bank account. So the business took a loan and we deposited it into bank. So who is going to do? Prof. Alexia, I think you are back. Can you attempt this one? What two accounts do we open? And who do we debit? Who do we credit? Oh, I think Prof. Alexia would. Prof. Alexia, can we hear from you? If not, I'll go to her lawyer, Prof. Bishop.
Okay, sir, please. We have loans account and bank account.
Exactly. So the loan account and the bank account. So who do we debit? Who do we credit?
Sir, please, we credit the loan account and we will debit the bank account.
Exactly. Thank you very much. So just to add to what he has just given us, if a business takes loan is a liability, right? So the liability loan will increase. So you open the loan account and if a liability is increasing, you are going to credit it. So that's why we'll open loan account. So loan, okay, and credit it. And the corresponding debit will go to the bank account. Why? Because we deposited the loan into a bank account. So bank was increasing. Okay. Why the loan they are to bank account? So your bank account, money in your bank account will increase. So you open loan account and bank account. Let me be sure that we don't already have, okay, we don't have the bank account. So we have to open the bank account, which is also here. So since bank is increasing and is an asset, we are going to debit bank and then credit the loan. So let me indicate the date. So the date was 10th March 2008. The details in the bank account will be the loan, and we put the amount 500, and we credit the loan 10th March 2008. The narration will be bank 500. So you see, as you solve more questions, you have to get certain things right, because it will never change. Anytime a business takes a loan, you open the loan account and credit it. And if the loan came in the form of cash, you debit it. If it came in the form of check or it was deposited in bank account, you debit bank. It will never change. In the UK, Canada, wherever you go, the principle is the same. Right. Thank you. The fourth one is bought vehicle 250 paying by check. Bought vehicle 250 paying by check. Okay, so what are the two accounts here? I think I'll do this one so that you can also clap for me. Me too, I deserve some applause now. So if the business bought vehicle is an asset. So we have vehicle, and then they also paid check. So that is bank. So the two accounts are vehicle and bank. Vehicle and bank. We already have the bank account, so we don't need to open a second bank account. But we don't have the vehicle account, so we open the vehicle account. Okay. Who do we debit? Who do we credit? It's very simple. If a business has bought a vehicle, it means the vehicle will increase. So asset vehicle increase, debit vehicle account. So that's on the 15th of March 2008. You debit vehicle with narration bank. Amount is 250. And you credit bank, because anytime you pay money out of your bank account, it decreases. And if asset bank decrease, we credit it. So 15th March 2008. Vehicle. That's 250. Very simple. Very, very simple. Let's quickly run through the rest and see if we can move on to balancing the account. So 21st, cash purchases. Cash purchases. So cash purchases means that the business bought goods and they paid cash. So here is between your cash account and your purchases account. Now let me ask my students, which account would you debit and which account will you credit? I think Frank will give us another EBA. Prof. Frank, yes, cash purchases. Who do we debit? Who do we credit?
Sir, please. I think we open cash and then purchases account.
Exactly. So we debit who?
We debit purchases account, then
Good.
credit cash account.
Exactly. That's brilliant. Thank you very much. So we would credit cash account. So we already have the cash account, so you don't need to open a new cash account. So come to the old cash account, put the date 21st March 2008. The details will be purchases, and the amount is 180. And then we'll go to purchases account and we debit it, right? I think these are things you have done. I'm just going over for us to be on the same page so that we can carry on to new things you have to learn. So in the purchase account, we show 21st March 2008. The details will be cash. An amount 180. Good. The next one, pay Jackie 250 cash. So we are paying Jackie. We are making payment to a person, Jackie. So Jackie's account and then cash account will be the two accounts. I'm sure Jackie would be our supplier or creditor. That's why we are paying her. So here we need the cash account, which is here, and then Jackie's account. So we don't have Jackie's account, so we need to open Jackie. So Jackie's account. So in terms of the debit and credit, if you are paying cash, you know, I've said it, if you pay cash, you credit cash, right? So we are going to credit cash. If you don't know even where to do the debit, you know that if you have done the credit, the corresponding debit will be in Jackie's account. So we'll debit Jackie 26 March 2008. We'll debit Jackie with cash of 250. And then we credit cash since we paid. So because we made the payment, cash decreased. That's why we are crediting cash. So 26 March 2008, Jackie 250. The last but one is withdrew 100 for private use from the bank. Withdrew 100 for private use. Please, we just ended discussion on this private use something. If this private use come into the picture, what happens? What term do we refer to? I think Alessia will do that. Alessia, I want you to answer this for me because your network is smashed.
Drawings.
Simply drawings.
Thank you very much. Drawings, good. So the two accounts, we have to open our drawings account, and the drawings was made from bank, so bank account, right? And I indicated to you that if the owner makes drawings, we debit drawings, so we need to open drawings account. So drawings, let me change the currency to CD. Okay, so we are going to debit drawings. We put in the date, which is 30th March 2008. The narration will be bank because we withdrew the money from bank. How much? 100. And then we credit the bank account. So we already have our bank account. You don't need to open a new one. So you come to your bank account, credit it, 30th March 2008, drawings, 100. Very simple. Very, very simple. The last one is bought goods on credits from Ivan. So another purchases, right, from Ivan. So we debit purchases and credit Ivan. We already have our purchases account. So what is left is Ivan account. Let me clear these things up. Yeah. And open my Ivan account. Ivan. Good. So we are going to credit Ivan since we bought goods from him without paying. So 31st March 2008, purchases 150. And then we'll go to the purchases account since we already have it in our books. Then we debit purchases 31st March 2008. Ivan. Okay, so that brings us to the end of the requirement that you should open the ledger account. So please, when the question asks you to open the ledger account, it means open the T account. But if the question asks you to show the effect on the accounting equation, then they are looking at increase in asset, decrease in liability dosage. So take note of that. So my lady and gentlemen, having done this, I'd want to quickly introduce to you what we call balancing of account and extracting a trial balance. So ideally, when you prepare your T account like this, at the end of the period, you have to balance it and move on to the following period. Okay, so that is what we are going to discuss in our next session. This session may end shortly or will end shortly. So pay attention. But I think I'll use a few minutes to quickly run through the balancing of account. Good. Now, when we talk of balancing of account, it's very simple, very simple. If you follow the principles to balance of account. Okay, so let me go back. Good, so it's here. Balancing of account. It refers to the process of determining the balance on an account at regular intervals to extract a trial balance. What is a balance in the first place? You remember we have two sides of an account, the debit side and the credit side. So the difference between these two sides is what is referred to as a balance, right? So this is so because, you know, you have amounts on these two sides. So when you tally them together, when you sum them up and you find a difference, right? The difference could be at this side or that side. And that difference is what we refer to as a balance. Now, if the difference is on the debit side, then we are going to call it something balance. If it's on the credit side, we are going to call it something balance. Okay, and so we have two main types of balances on an account. It's either a debit balance or a credit balance. It's either a debit balance or a credit balance. So if you want me to read some of the English to you, I think I can do that here. As is on the screen. Balancing of account simply refers to the process of you determining the difference on an account to be able to extract a trial balance. And we'll know what a trial balance is shortly. But a balance is the difference between the debit side and credit side of an account. There are two main balances, debit balance and credit balance. What is a debit balance? A debit balance occurs or is a balance on account when the debit side is greater than the credit side. So since we have some accounts on the screen, let's focus on the cash account. We are saying that when the debit side, okay, is greater than the credit side, then this account has a debit balance. So the opposite is for a credit balance. A credit balance means that the credit side is greater than the debit balance. So can we do some examples here? Please, within 1 minute, compare the two sides of this cash account and tell me, would it have a debit balance or a credit balance? We have 1 minute to do that, or even 30 seconds. Yes, Prof. Richmond. Please increase your a debit balance. Why? Because the debit side, the amount at the debit side is more than the amount on the credit side. Because if you add 180 and 250, I think that will give you 430. compared to what is on the debit side, which is 1,000. So the debit side is more than the credit side. And so this account would have a debit balance. If we look at the capital, the credit side is 1,000, the debit side is 0. So this capital account would have a credit balance. So that is just to tell you about the two types of account and what, or two types of balances and what they mean. We'll continue with the steps in balancing an account in the next session. So please join me. Don't miss it. Don't let your network mafia you. We overcome any network malfunction in the name of Jesus, in the name of Allah, in the name of anything that you worship. Amen. Okay, so I'll see you in the next session.